Inflation as hidden taxation. Inflation acts like a hidden tax because it reduces the purchasing power of money without requiring the government to openly raise tax rates. When prices rise, the same amount of cash buys fewer goods and services. If someone holds $10,000 in savings and inflation is 5%, that money loses roughly 5% of its real value over a year. No tax bill arrives, but wealth has still been taken in real terms. The key mechanism is simple: governments can finance spending by creating money, borrowing from central banks, or allowing monetary expansion. This increases the money supply relative to goods and services. The result is price inflation. The cost is paid by everyone holding currency, wages, fixed pensions, and savings. This is why inflation is called a tax on money holders. It is hidden because first, it doesn't require parliamentary approval like normal taxation. Second, people often blame businesses, supply chains, foreigners, or markets before blaming fiscal and monetary policy. Third, the burden is spread across billions of people, so the damage feels gradual rather than immediate. Fourth, inflation transfers wealth quietly from creditors to savers to debtors, from creditors and savers to debtors and asset owners. The inflation benefits certain actors. Governments benefit because the real value of public debt falls. Borrowers benefit because they repay loans with cheaper money. Asset owners often benefit because real estate, stocks, commodities, and businesses may rise in nominal value. The losers are cash holders, wage earners, pensioners, poor householders, and anyone whose income doesn't rise as fast as prices. The poor suffer because the poor suffer more because they spend a larger share of income on essentials like food, rent, transport, and energy. The brutal reality: inflation is not equally distributed pain, it is a silent redistribution machine. A normal tax says the state is taking this much. Inflation says nothing, it simply makes your money weaker. Inflation is not just rising prices, it is a systematic mechanism of value extraction. Unlike explicit taxation, which is visible and legislated, inflation appears quietly through monetary expansion. It redistributes purchasing power without requiring direct political confrontation. The core thesis of this presentation is that inflation functions as a hidden tax, one that is structurally embedded in modern monetary systems. Understanding inflation requires shifting perspective from consumer price increases to power dynamics: who benefits, who loses, and how economic value is transferred across economic agents without formal consent. Inflation refers to the persistent increase in the general price level across an economy. It is not a one time shock or isolated price spike, but a sustained erosion of currency value. Metrics like the Consumer Price Index and the GDP deflator attempt to quantify this. Though they are imperfect proxies, the important distinction is that inflation is monetary in nature. It reflects too much money relative to available goods and services. From a taxation perspective, inflation reduces real wealth holdings. The nominal number remains constant, but its real purchasing capacity declines. That is the extraction mechanism. The mechanism is mechanical. When the money supply increases faster than real output, purchasing power dilutes. Governments finance spending through deficits. Central banks often monetize these deficits by expanding the monetary base. This creates additional liquidity without corresponding productivity gains. Prices adjust upward. The critical point is that holders of money experience a decline in real wealth. This is economically equivalent to taxation, but without explicit collection. The state extracts value through dilution rather than direct seizure. Inflation is hidden because it bypasses traditional accountability structures. Taxation requires political approval and is visible to voters. Inflation does not. It operates through central banking and fiscal coordination, often shielding from direct scrutiny. The narrative environment further obscures it. Price increases are attributed to supply chains, corporate greed, or external shocks. While these factors can contribute, the underlying driver remains monetary conditions. The gradual nature of inflation reduces behavioral response. People adapt instead of resisting. This is why it is effective as a tool of extraction. The burden of inflation is asymmetrical. Those holding cash or fixed income assets are primary victims. Wage earners are also exposed because wages adjust slowly relative to prices. Pensioners face direct erosion of purchasing power. Low income households are disproportionately affected because they allocate a higher share of income to essential goods, food, rent, energy, categories that often experience higher inflation volatility. Inflation functions as a regressive tax. It extracts more from those with fewer tools or hedge against it. Inflation creates winners. Governments benefit because inflation reduces the real burden of public debt. A fixed nominal liability becomes easier to service in inflated currency terms. Borrowers gain for the same reason. Their obligations shrink in real value. Asset holders often benefit because nominal asset prices tend to rise with inflation. Corporations with strong pricing power can pass cost increases to consumers, preserving margins. The system is structured to shift value upward and downward, those already positioned with capital structure. Explicit taxation is transparent. It is legislated, targeted, and politically contested. Inflation taxation is implicit. It is executed through monetary expansion diffused across the entire population. Explicit taxes can be progressive or regressive depending on policy design. Inflation is inherently regressive because it disproportionately affects those holding cash and lacking financial hedges. The key distinction is consent and visibility. One is acknowledged extraction, the other is disguised dilution. Inflation aligns with sovereign incentives, especially in high debt environments. Governments facing large debt burdens benefit from moderate inflation because it erodes liabilities in real terms. Instead of politically costly tax hikes or spending cuts, inflation offers a passive adjustment mechanism. However, this introduces second-order effects: loss of credibility, higher future borrowing costs, and potential currency instability. The short-term relief trades off against long-term structural risk. Inflation becomes a strategic tool, not an accident. Inflation alters behavior. Individuals focus on nominal increases, higher wages, rising asset values, while ignoring real purchasing power erosion. This creates an illusion of progress. Savings become less attractive because their real value declines over time. Consumption creates as holding cash becomes costly. Capital shifts towards speculative assets in search of inflation protection. These behavioral shifts reinforce an inflationary cycle and amplify inequality between asset holders and non asset holders. Inflation is not a free tool. Excessive use leads to system breakdown. Hyperinflation destroys currency credibility entirely, collapsing savings and economic coordination. Even moderate inflation, if persistent, can trigger currency depreciation and capital flight. Investors demand higher returns to compensate for inflation risk, increasing borrowing costs. Trust is the core constraint. Once lost, monetary systems destabilize rapidly. The hidden tax becomes visible and resistance emerges. Historically, inflation has been used repeatedly as a tool of adjustment. Post war economies used inflation to reduce debt burdens. The 1970s demonstrated the risk of uncontrolled inflation combined with stagnation. In modern economies, quantitative easing has expanded monetary bases significantly, raising concerns about long term inflationary pressure. Emerging markets frequently experience inflation cycles due to weaker institutional controls. The pattern is consistent. Inflation emerges where fiscal pressure meets monetary flexibility. Inflation is not neutral, it is a structured mechanism of redistribution embedded within modern economic systems. It shifts value from passive holders of money to active controllers of capital and policy. It allows governments to finance deficits without direct confrontation. It rewards those positioned in assets and punishes those exposed to cash. The conclusion is direct. Inflation is a form of power. Understanding it requires abandoning the consumer level narrative and analyzing it as a strategic instrument of control and resource allocation. Inflation as hidden taxation, the silent architecture of monetary extraction. Point number one: the core thesis: inflation as an instrument of power. Inflation is not merely an economic phenomenon characterized by rising prices, it is a structural mechanism of wealth transfer embedded within modern monetary systems. To treat inflation as an accidental byproduct of economic cycles is analytically weak. Inflation operates as a silent extraction tool, functionally equivalent to taxation, yet devoid of explicit political confrontation. Where conventional taxation is legislated, debated, and resisted, inflation bypasses these frictions by operating through monetary channels. It doesn't ask for consent, it reinforces redistribution through erosion. The defining feature of inflation as a hidden tax lies in its asymmetry of perception. Nominal value remains visible and often increases, creating an illusion of stability or growth, while real value deteriorates. This gap between perception and reality is the operational space where inflation extracts wealth. The system doesn't confiscate assets directly, it weakens the unit in which assets are measured. The result is identical, a transfer of purchasing power away from holders of money towards those positioned to exploit the inflationary environment. Point number 2, the monetary foundation, how inflation is engineered. Inflation originates in the imbalance between money supply and real output. When the supply of money expands faster than the production of goods and services, the value of each unit of currency declines. This is not an abstract theory but a mechanical relationship embedded in monetary economics. Central banks, through tools such as the open market operations, interest rate manipulation, and quantitative easing, regulate the supply of money. Governments use fiscal deficits and create the demand for such expansion. The interaction between fiscal and monetary authorities is critical. Governments spend beyond their revenues, issuing debt to finance the gap. Central banks directly or indirectly absorb the debt, injecting liquidity into the system. This process increases the money supply without a corresponding increase in real economic output. Prices adjust upward. The mechanism is impersonal but predictable. Inflation isn't random. It is the outcome of deliberate policy choices constrained by political and economic incentives. The disguise why inflation avoids political resistance. Inflation persists as a hidden tax because it avoids the institutional constraint faced by explicit taxation. Direct taxes are visible, itemized, and politically sensitive. They require legislative approval and are subjected to public scrutiny. Inflation, by contrast, is mediated through complex financial systems that obscure causality. The average economic agent doesn't trace rising prices back to monetary expansion. Instead, blame is distributed across convenient targets such as corporations, supply chains, or external shocks. The gradual nature of inflation further reduces resistance. Unlike a sudden tax increase, which triggers immediate backlash, inflation erodes purchasing power incrementally. Behavioral adaptation replaces opposition. Individuals adjust consumption patterns, seek higher wages, or reduce savings, but they rarely mobilize against the underlying mechanism. This diffusion of impact is not accidental, it is what makes inflation politically viable as a tool of extraction. Point number 4, the redistribution mechanism, winners and losers. Inflation is not neutral, it redistributes wealth among identifiable lines. The primary losers are those holding nominal assets, cash balances, fixed income securities, and wages that adjust slowly. These actors experience a direct decline in purchasing power. The erosion is continuous and unavoidable unless they actively hedge against it. Conversely, inflation benefits debtors and assets holders. Government, as the largest debtor in modern economics, benefits significantly. Inflation reduces the real value of public debt, effectively transferring the burden from state to currency holders. Private borrowers similarly benefit, repaying loans with devalued currency. Asset owners, particularly those holding real estate, equities, and commodities, often experience nominal gains that outpace inflation, preserving or even enhancing their wealth. The asymmetry transforms inflation into a regressive tax formation. It extracts proportionally more from those with limited financial sophistication or access to hedging instruments. The system rewards those already positioned within capital markets while penalizing those dependent on fixed income or cash savings. Point number 5, the debt imperative, inflation as a strategy of survival. Modern states operate under structural debt pressures. The fiscal deficits are persistent, driven by political incentives to spend without imposing corresponding taxes. As debt accumulates, the cost of servicing it becomes a central constraint. Inflation emerges as a strategic response to this constraint. By allowing prices to rise, the governments reduce the real burden of their liabilities without explicit default. This strategy is not without risk. It is often preferred over other alternatives. Raising taxes directly is politically costly. Cutting spending risks social and economic instability. Default damages credibility and access to capital markets. Inflation is the fourth pillar, a gradual, less viable adjustment that shifts the burden onto the population at large. It is, in effect, a decentralized tax collected through currency depreciation. Point number 6, behavioral distortion. The psychological dimension of inflation. Inflation reshapes economic behavior in ways that reinforce its own persistence. As the real value of money declines, the incentive to hold cash diminishes. Individuals increase consumption or shift savings into assets perceived as inflation resistant. This accelerates velocity of money, further contributing to price increases. Nominal illusions play a critical role. Wages increase, asset prices appreciate, and revenue growth create the perception of prosperity, even when real gains are minimal or negative. This perception delays corrective action. Economic agents respond to nominal signals while the real underlying conditions deteriorate. The system sustains itself through this cognitive distortion. Point number 6. Point number 7. Institutional shielding, central banks, and the narrative of independence. Central banks occupy a unique position in the inflationary process. They are formally independent institutions tasked with maintaining price stability, yet they operate within a framework that often aligns with fiscal objectives. This institutional arrangement provides political cover. Inflation can be attributed to technical policy decisions rather than political intent. The narrative of independence obscures accountability. When inflation rises, central banks adjust interest rates, signaling corrective action. However, these adjustments often lag behind the initial expansion of the money supply. The cycle repeats expansion, inflation, and partial correction. The system maintains a controlled level of inflation and facilitates fiscal objectives while avoiding overt instability. Point number 8. Historical patterns. Inflation as a recurrent tool. History provides consistent evidence of inflation functioning as a hidden tax. Post-war economies used inflation to reduce debt burdens accumulated during conflict. The 1970s demonstrated the consequence of excessive monetary expansion combined with supply shocks, resulting in stagflation. More recently, the quantitative easing policies have expanded central bank balance sheets to unprecedented levels, raising concerns about long-term inflationary effects. Emerging markets offer more extreme examples, where institutional constraints are weaker and inflation becomes more volatile and more visibly destructive, yet the underlying mechanism remains the same. Monetary expansion used to finance fiscal needs, resulting in wealth transfer through currency devaluation. Point number 9. Structural limits. When the hidden tax becomes visible, inflation operates effectively as a hidden tax only within certain limits. When inflation accelerates beyond moderate level, its effects becomes undeniable. Hyperinflation represents the breakdown of the system. Currency loses its function as a store of value and medium of exchange. Economic coordination collapses entirely. Even at lower levels, persistent inflation erodes trust. Investors demand higher returns, increasing borrowing costs. Capital seeks more stable environments, leading to currency depreciation and capital flight. The hidden tax becomes visible, resistance emerges. The system must then either stabilize or face structural crisis. The structural reality, inflation as a tool of control. To understand inflation purely as an economic variable is insufficient. It must be analyzed as a tool within a broader system of power. Inflation allows states to finance operations, manage debt, and influence economic behavior without direct confrontation. It redistributes wealth in ways that reinforce existing hierarchies. It operates within complexity perception gaps and institutional shielding. The strategic reality is clear. Inflation is not an anomaly, it is a feature. It is embedded in the architecture of modern economies because it serves functional purposes for those controlling monetary and fiscal levels. The cost is borne diffusely, the benefits are concentrated. Point number 11. Conclusion. The silent extraction. Inflation functions as a silent extraction mechanism. It doesn't announce itself as a tax, yet it performs the same role, transferring resources from the population to the state and to those positioned within the capital structure. Its effectiveness lies in its invisibility, its gradualism, and its complexity. The outcome isn't accidental, it is predictable result of incentives operating within modern monetary systems. As long as these incentives persist, inflation will remain a central but understated component of economic governance.